Hello viewers, welcome to the first live session on the course Mathematical Portfolio Theory. Thank you all for joining. So at the beginning, I'll just go through the questions that have been posed on the spreadsheet. So essentially, there is just one question from Jigar, and Jigar is asking about optimization, time series analysis, neural networks, and so on, and how these are going to help in in a career in the finance domain. So here I want to respond saying that all this optimization and time series analysis has always been a very integral part of fund management or asset management, and certainly, of course, you can use them. Neural network application is slightly newer domain, and more importantly, what I would suggest at this point of time is that you focus a little bit more on data science approach, such as looking at statistics and try to see if you can acquire certain skill sets in terms of programming in Python and R, which are going to be the backbone in case of data science applications in finance. The other questions, of course, there were just a couple of observations that we had. So I request you all to please post your questions on the YouTube chat box instead of the spreadsheet, so that your queries are visible to everyone and can be addressed. So now I invite the participants. I can see only 5 people have joined. So I just want to request everyone to start posting their queries on the chat box, and I'll address them one by one. So please post your queries in the chat box. So this is a request again to please post your queries, whatever you would like to be, or your questions and concerns that you would like to be addressed. Okay, so while we're waiting for people to post their queries, let me just talk a little bit about why we need portfolio theory and the optimization technique. So far we have been looking at the probability theory, and we are currently looking at modern portfolio theory. And now the modern portfolio theory due to Markowitz is what is known as the mean variance portfolio theory. And for a long time, the investment decisions were actually driven by sort of individual specific viewpoints of things without any uh, logical and structured mathematical framework to drive their decision. So a lot of times a decision might be made based on whether you are achieving a higher return on a particular asset without recognizing the fact that anything that is offering a higher return is likely to also be accompanied by a higher amount of risk. And it is only Markowitz in his modern portfolio theory that he actually uh, reconciled these two concepts of returns and risk, and subsequently some of the shortcomings were observed in it as was outlined in the class, and then this was an alternative to this in the terms of non-mean variance portfolio theory was brought forth. And this non-mean variance portfolio theory, one of the key things was that the risk component of that was driven by the fact that you need to penalize any return that is actually below your expectation, and that is how these notions of or the concept of safety first criteria and semi deviation and semi variance and so on came into the picture. And from a practical point of view, you need to actually use optimization techniques to reach your optimal portfolio. And in the course, we'll talk a little bit about utility theory, which is a very key concept in economics. And once that utility theory is set up, then we talk about what is known as dynamic programming and Hamilton-Jacobi-Bellman equation. And finally, towards the end, we talk about two key important aspects. One of them is the bond portfolio optimization, where you explore the reasons why you consider bond to also have risk and how to mitigate that risk, and also risk minimization. Now, financial risk management has emerged as a very, very critical area to protect the banks against suffering large losses and to have the capital required to mitigate in the event that a loss actually happens. And one key measure of that risk is what is known as the value at risk or VAR. And finally, in the last week of the course, what we will do is that we will look at some MATLAB examples. So that will give you some insight into a practical application of how you can actually choose portfolio, designs portfolio according to your needs by putting in constraints, constraints such as how many assets you want to invest in, or maybe a constraint on what is the maximum percentage of your wealth that you want to invest in a certain class of assets, and so on. And with that approach, you should actually be able to download or get your data of all the assets that you want to invest in and design your own portfolio. So that is one of the eventual goals of this particular course. Okay, so there is just a brief sort of epilogue, I must say, since this introduction was already given earlier, but just a brief recap of what I intend to cover in this course. So now again, could you please post your queries here? Okay, so you please, if you have any queries, please post them in the next 4 or 5 minutes. And if there are no queries, then I think we can, you know, we can conclude the session if there are no queries. But so I'm just requesting and giving you some time to post your queries so that they can be addressed. So please start posting your queries in the next 4 to 5 minutes. So while we are waiting for the queries over the next 3 or 4 minutes, let me just reiterate one more point as to why portfolio theory is coming and playing a major role. See, traditionally, in our investments have been very limited in nature in terms of people investing in deposit accounts in banks, or a small percentage of people getting into investments in equities. But over the last couple of decades, the nature of investment options that are available to investors has increased enormously, which in turn has actually propelled the necessity of having trained professionals who can actively manage a fund. Particularly, one common example that we talk about that comes to mind when you are talking about portfolio is mutual funds, where essentially small sums of money from an extremely large number of investors are pulled together and invested. And so you can view that as some sort of portfolio optimization technique with the money that is collated from a large number of investors. And another place where this portfolio theory approach has a meaningful role to play are pension funds. So as you are moving towards pension funds that are being actively managed, and you have a lot of different choices in terms of pension funds. So what those pension funds do is essentially they take your money and that they invest, and then again also your portfolio theory starts to play a very important role. From that point of view, mathematical portfolio theory, this course is very, very important if you are looking at trying to figure things out for yourself as to how one can make an investment decision. And the goal is to give you a basic introduction and an idea, an insight into actually how this notion or this concept of portfolio theory actually works, and more importantly, what are the mathematical framework and the mathematical techniques that are involved in case of design and analysis of portfolios, and consequent performance analysis of such actively managed portfolios. Okay, so we will wait for a couple of more minutes in case there are any questions that people would still like to post. So as I said, I request you to please uh, post this on the chat box. Okay, so K Prabhat has asked a question. Are the theoretical concepts learned in the course applied in firms in industry? Yes, the concepts that you have, these are very much applicable from the industrial point of view. Of course, the industry is likely to be using them, at a slightly more sophisticated level, but certainly it gives you a good point. The course offers you a good starting point to have some basic insights into how things would actually work in a real market situation. So the answer to your question, yes, this course is very much relevant to from the point of view of what is being done in the industry. So we'll just wait for another 1 or 2 minutes to see if there are any further queries, and if not, we'll conclude the session in that case. In the meanwhile, if you feel there is something you need to be discussed, please post that in the chat box. So as I can see, there are no further questions. Okay. There is K. Prabhat has asked one more question. Uh, so it says that in week 2, the assignment, couple of questions like the number of payments were ambiguous. I've sent a query for considering different point of view. Can you please address that? Yes, Prabhat. So the question is that the confusion from what you have said, it seems to me, is because that there is a the concept of coupon bonds. So when you talk about coupon bonds, we don't include a zero coupon bond because a zero coupon bond does not have any coupons. So please remember that a coupon bond involves a series of periodic payments that come, which are called coupons, and at the final time point there is going to be a coupon plus there is going to be the face value that is going to be paid. So in case of a zero coupon bond, there is going to be there is uh, there is going to be only one payment that is at the final time point. But since you have raised the questions, I'll just have a look at it once again. So since you have raised it from the considering a different point of view. Okay. So please understand that in case of a coupon bond, there has to be at least two payments. There cannot be just one payment. The one payment is the case when it is a zero coupon bond. There is one final payment that is going to happen. But in case of a coupon bond, there is obviously going to be a payment that is happening at the maturity, and there has to be at least one payment that happens in between. So that means there has to be at least two payments that have to take place. Yes, Rahul, you had some question? Okay, so Pankaj Kumar Agarwal has raised a question. I'm not clear about the GBM model, so please suggest what to do. So I'll just briefly explain, go through this in brief as to what is the geometric Brownian motion model. So what happens is that, can you move to Windows Journal? So the geometric Brownian motion, you will recollect that this is going to be equal to ds is equal to mu s dt plus sigma s dw of t. So what it does is that this gives you basically an evolution of the stock price over time. So for example, if I don't have this term, then the remaining terms, they are going to be deterministic. So if I have ds is equal to mu s dt, and I solve this subject to, if I solve this subject to that initial stock price S0 being equal to S0, then if you solve this, or this is the ordinary differential equation, so you will get S of t is equal to S0 into e raised to mu t. But so this is a purely deterministic quantity. So this obviously cannot be, so this acts more like a bond where you start off with an initial investment of S0, and at time t, if your interest rate is mu, then the amount that you receive from the bond is S naught into e raised to mu t. So in this case, you see that this is a purely deterministic quantity and you are able to predict what is going to be the S of t. S of t, if you start off with an initial amount of S of 0. But in case of a stock price, things are not deterministic or known. So accordingly, what you have to do is that you have to consider some sort of a random component when it comes to evolution of the stock price. So accordingly, we have this model, and this model is essentially the solution of this model turns out to be equal to St is equal to S naught into e raised to e raised to mu minus half sigma square into t plus sigma w of t. So if you observe carefully here that if this is the valuation of a bond starting off with an amount of S naught and the interest rate of mu, the corresponding differential equation is going to be an ordinary differential equation, which is ds equal to mu s dt. However, this mu s dt is not enough to catch the randomness that is exhibited by a stock. So accordingly, we add a term sigma s into dw of t, and this turns out to be equal to, the solution of this can be proved to be St is equal to S0 into e raised to mu minus half sigma square of t plus sigma of Wt. And since Wt is a normal distribution, so that means this entire expression is going to be a random quantity. So your e raised to that random quantity is going to be random. So accordingly, your S of t is going to be random as it evolves over time. And secondly, you please observe that even if the W of t becomes an extremely large negative quantity, it does not matter, because the entire exponential term that you have here, e raised to any quantity, is going to be positive. So that multiplied with S of 0 gives you a positive value. So this model also ensures that your S of t is always positive. Okay, so this was one question I wanted to add. Alright, so in the chat box, Rahul wants to ask this question, that he is facing difficulty in understanding the matrix formulation of efficient frontier deriving A, B, C, D. Okay, so it will be a little difficult for to work out the details here. So I have already defined what my A, B, C, and D are. And once you do that, I suggest that you please work out the details and you derive for yourself. So what I suggest that you just derive the entire expression up to whatever point you can, and if any help is needed, you just post it on the group, and then I will help you work through the computation. It's basically, you have to be you have to patiently work through the formulation of ABCD. In this case, Rahul has asked, is it important for having a grasp for just the derivation of the final result? Well, I mean, of course, you have to understand what is the process by which the derivation is happening, and consequently how you get your G and H vector. That is of course very important, but also it is critical for you to understand the result in the context of this G and H vector, how the minimum variance line comes, and how the two-fund theorem, and what is two-fund theorem comes, and what is the interpretation of that, and how you can actually generate the entire minimum variance line by using this formulation. So I don't want to create a sort of a hierarchical or a preferential criteria in terms of whether the derivation is important or whether the result is important. Both have their importance. I mean, the derivation is important in the sense that if you want to look at the variation of it, and you want to derive a more generalized result, then obviously the understanding of this basic derivation is critical, and the result is important in the sense that it will be relevant in terms of getting an idea about how this application is going to work out. So basically, there are lots of applications of this minimum variance line and the two-fund theorem. So accordingly, you need to have an appreciation of the importance of this result from the point of view of application. So each has its own importance from its own different perspective. Okay, again, Prabhat has again asked the question. I believe I have already addressed this once in the question. Is that dividend yield? And you are saying that the only reason I didn't mark it is because I thought it was a trick question since capital gain isn't a ratio where yield is. Well, my question was this: which of the following can be earned by a stockholder? So I don't think my question at any point indicated that the notion of earning the signed out. Okay. So the notion of this is, at no point did my question indicate that this the can can be earned by shareholder. It did not indicate that can be earned in terms of any percentage. It can be any form of earnings, and that includes dividend yield also. Okay, I think Pankaj Agarwal has asked another question, and that question is regarding, do I need to understand the derivation of GBM? Yes, it is a good idea to understand the derivation of GBM simply because uh, as I've explained in whatever I wrote just now, the how you move. See, I have given you an ordinary differential equation in case of a bond, and how you move. How exactly do you justify the moving or transitioning from the deterministic model without the W term onto the stochastic model for the stock price with the W term? The logic behind it is very important. I mean, why have I chosen that particular model with the term sigma s into dw of t? That is important, and you need to have a greater clarity on this as to how it comes about, so that yeah, you are convinced about why the model appears in that particular form, and that is the reason why the understanding of the derivation of the GBM is also important from the broader perspective. So does anyone have? So please post your questions on the chat box instead of the spreadsheet. Just, the reason I'm saying that, please post it on the chat box so that it is visible for everyone and everyone can benefit from the question. So I can see the Pankaj, Rahul, Prabhat. These are the three people who are online. Somebody else has joined us just now. Thank you, Rahul. So Pankaj Agarwal, did you have any other clarifications you wanted on the GBM? I've just given you a broad gist of it. Is there anything else you wanted to ask? Well, I mean, you want to build a career. So, Jigar Kumar Shah has asked, and he has said you are from EC background, have taken it. This, I believe I've already addressed these questions earlier. So, you are interested in building a career in financial management and prediction. Well, I mean, this course is one of the places where you start, but you will, of course, need to have a much broader idea. because and quantitative finance is not just about portfolio theory. It also involves pricing mechanism. It also involves financial risk management, and it also involves computational finance. So the two other, apart from mathematical portfolio theory, the two other places you should look at is the first one is you need to look at more about pricing, and the second one is you need to look about risk management, and also you need to have more computational skills. So a couple of things I can recommend in terms of computational skills is one is that you should be aware of Monte Carlo simulation, and secondly also you need to develop programming skills in a language like Python or R, since Python is designed and is very amenable to handling data, and R is of course is the sort of the most prevalent and widely accepted open source statistical package, because at the end of the day a whole lot of this process of financial management and prediction involves handling of large sets of data. And also another point where you can start off with, if you want to talk about a little bit about financial management, uh, which will include all the topics, a book that I would recommend, uh, that book could be John C. Hull on options, futures, and other derivatives. It's a globally accepted book. Explains this very nicely at a basic level, and it will give you a very broad perspective of how financial markets work, aspects of risk management, and some brief insights into how the market is working. Okay, so Rahul Yadav, is there any tool we'll be using in future to model which you are learning, like Excel or Python? Excel and Python are both, of course, useful tools from the practical point of view. And so in the future, I don't know, I presume that you'll be using in the future, you mean for the perspective of this course. So in this course, the last week we will be using MATLAB. The reason why I chose MATLAB is that MATLAB has an inbuilt finance package, which is very user friendly, and it will, in case of Python, of course, you have to know more programming skills. But in case of MATLAB, it is everything is inbuilt into the financial toolbox, and it is some very nice examples, very comprehensive examples when it comes to portfolio management. So that is something we'll be doing in the towards the end of this particular course. And in case I interpret your question about the future in a broader sense, the future to model which will belong, model where we will use Excel or Python, definitely. From as things stand now, it certainly looks like that Python will have a very important role to play in the long run, especially in any kind of data-driven analysis, which is essentially the backbone of how things are handled in finance. So I think Python at this point is definitely an important skill to learn from the perspective of how things are likely to go in the future. Okay, so if you have some other questions, please post them in the chat box. Thank you, Jigar Kumar Shah. Okay, okay, Rahul, thank you. So regarding MATLAB, I believe that MathWorks will give you a license for the duration of the course, which will help you explore. What we will do in the last week of the course is I picked up some examples. We'll look at step by step how we can create portfolios. But there are a lot more examples beyond that in the financial toolbox. Financial toolbox actually has a lot of interesting functions now. So you're welcome to, of course, explore that at this point itself, and you can actually work on MATLAB live on their server. So I certainly encourage, if you want to start working on MATLAB, that would actually be a good idea at this point of time. Does anyone have any other questions that you would like to pose? Jigar Kumar Shah. So he says that can you suggest good journals where research related to modern portfolio theory uh, are published? Well, I mean, one place you can look. I would say one of the benchmark journals is SIAM Journal on Financial Mathematics. I believe that is what was the name. You can actually also look up some journals. There is some ABDC or Australian Business Dean Council's list of journals which identifies some of the best journals in the area. I suggest that is one place to look at. You can look up the risk group of publication to see what they are doing in terms of this, and a lot of portfolio theory work from the mathematical point of view do tend to be published in mathematics journals. Right. So I would recommend that these are the places that you need to look at, particularly the ABDC list. They will give you a comprehensive list of journals and they will categorize them in terms of uh, I mean, those are mostly finance and economics journals, so that is a good place to start, and they will list them in terms of their quality. Okay, Pankaj Agarwal has asked that what topics in matrix algebra which one needs to master for mathematical finance. I think from the point of view of the broader perspective of mathematical portfolio theory, you pretty much just need some basic matrix algebra. In fact, the only time in this course we'll be using matrix, this linear algebra. Matrix algebra is when we are doing modern portfolio theory. But otherwise, it does not, at a basic level, matrix algebra does not have a lot of presence in mathematical portfolio theory. Okay, please suggest an easy to follow book or a course covering the topics you are about to answer. You see that as indicated at the end of each of the video lectures, I've been using different books for this purposes. But one of the currently the part that is available, that is the material that has been released, has been done from this book by Francis and Kim. So that is one place you look at, and the entire list of books that I have referred to, that those are actually available on the course web page, but there is no single book in portfolio theory that I can suggest that really is easy to follow. So I suggest that you, as we are moving across the topics, it is a good idea to please refer to the books that are have been identified as references at the end of each lecture and that have been listed on the main course web page. But probably Francis and Kim might be slightly easier to follow amongst all the books that are listed. So please post your queries. So I am not aware of certified financial planning. What exactly? I don't know the details of this. So I'm not in a position to uh, really answer your question regarding the validity or the credibility of. I'm presuming that this is some sort of a charter or a certification program where you have to take a series of exams. But I am not aware of the details of this, so it will be sort of difficult for me to uh, make a statement about to what extent it is helpful and whether it is credible or not. Okay, thank you, Pankaj Agarwal and Jigar Kumar Shah. So please post your queries. So we have come to the last quarter of the scheduled period for the session. So please post your queries here. Okay, Rahul has made an observation that I have a data science background and I want to enter in the field of quantitative finance. What are the other concepts in a broader perspective required for the same? Okay, so this is a good question. You say that you have a data science background, so I'm presuming that you have a sufficiently elaborate and extensive background in coding. So if you want to enter quantitative finance, I would suggest that, as I had mentioned earlier, that there are lots of different parts of quantitative finance, and if you want to specialize in asset management, then of course this is the place. If you want to look at broader quantitative finance, then a broader perspective on mathematical finance in terms of pricing of derivatives, particularly the basic derivatives of forwards, futures, options, and swaps. These are critical. Another important area which is becoming very very essential in the finance industry and also is getting a lot of importance from the point of view of regulators is the financial risk management, particularly in compliance with the Basel regulations for banking sectors. So financial risk management would be another place to look at where a huge amount of data analysis goes on, along with, of course, you need to have the mathematical and statistical understanding as well as the finance perspective. So I would say that asset management, risk management, and pricing are some of the places you can consider with a particular emphasis on risk management is what I would suggest. Considering the fact that you say that you have a data science background, so risk management might also be a good place to look at. So we have about 10 odd minutes left for the scheduled conclusion of the session. So I suggest to please post your queries as soon as you can. Thank you, Rahul. So just waiting for any other queries that you might have in the next couple of minutes. So just we'll just wait for your questions for 1 or 2 minutes. And in case there are no further queries, we'll start winding up and concluding the session. Jigar Kumar Shah, I am not aware. I am not an electrical engineer by training, so I do not know of any book or material that could reconcile the concepts of signal processing and mathematical financial econometrics. There probably is, but I'm not aware of it. If anyone has any other queries, kindly post it in the chat box. Okay, thank you, Jigar Kumar Shah. So, any concluding queries from anyone may please be posted on the chat box. So it looks like that there are no queries. I do not see any more queries on the spreadsheet, and I don't see any other queries on the chat box. So if there are no other queries, we will just, you know, I guess we can conclude the session. So I'll just give a half a minute, just in case people want to ask something else. And if there are no other queries, then we can conclude the session for today. Okay, so it looks like there are no further queries. So thank you all for joining in today's session. We had a quiet start, but then we had a very interactive session with a lot of enthusiastic participation. I can see there are just 4 people left now, so I hope that in the next live session we have a larger group of audience and we continue to have these strong interactive sessions. And in the meanwhile, just to remind you that please keep posting your queries on the forum, on the Google forum, and that can be accessed on the questions link that is available on the top of the main page for the learners. So I'll try to address your queries as soon as I can. So I think we can conclude the session for today, and I look forward to much larger participation in the next live session that we have for the course. So thank you for watching.